I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Let's get straight to the burning issues in private markets. The unbalancing effect of cash floods. Investors race into venture capital funds while getting increasingly wary of cash-burning IPOs. Then diagnosing the demise of Fairway as a test case for private equity. And we speak with Starwood Capital's Armin Rothhauser about the record amounts of dry powder on the books of infrastructure funds. Well, let's get into some of these burning issues. With me is Bloomberg Sonali Basak, Adam Temkin, and Kelsey Butler. Let's start with Sonali on Casper, testing the first IPO for cash-burning companies since WeWork. What's the appetite like, Sonali?
Well, listen, Casper was an unicorn last year, and as it goes into an IPO, it looks like it'll be worth less than it was in its last private financing round. So what does that mean? It creates a sense of worry that when people start to exit, they won't be able to exit at the same returns that they had in the past.
So there's a concern that at a time when you're seeing these private valuations come into question, you're still seeing record amounts of money getting raised on the venture capital side. What is that telling you? Who's raising money and how is the appetite there?
Well, the question is how fast can they put that money to work, right? If you're investing in venture capital and even growth equity, it's not a huge amount of money to put to work at one time. The idea here is, yes, you'll get a lot of zeros, but hopefully you'll get some good exits. But what happens if those markets are not receptive enough to get that exit you need for that return? Will the returns come down in the future?
Is that stifling fundraising on the venture capital side?
Right now, there's no evidence of it, right? We have DoorDash also coming up ahead, big loss-making company. We have Airbnb, which can be profitable. And so there's a couple chances this year for the public markets. Remember, fewer companies are going public in general. So the investors coming into them might still want to bite when there's so few of them left.
All right, we'll see. But it brings us to Adam. CLOs, meanwhile, have been underperforming other types of credit, but are starting to come into favor again. This goes to the whole flood of cash issue. What's the relative valuation case for CLOs being made right now?
All of last year, CLOs were cheap to investment-grade corporate. So right now, spreads are just beginning to tighten again, but they were a great value last year. However, there's a lot of risks, as we know, in leveraged loans.
Well, okay, so the risks in leveraged loans and CLOs, collateralized loan obligations, are packaging these leveraged loans, structuring them into a waterfall kind of structure. Are there inherent risks that are getting kind of embedded into the structures of some of these funds that sort of are different from the plain vanilla securities?
Absolutely. As leveraged loans are being downgraded to CCC, this is causing a problem. So CLO managers are looking for more freedom and flexibility to get kind of distressed loans in there. That's not great for all investors in the CLOs, and they're kind of fighting back at these loopholes and documentation changes.
Is anyone saying that this market's getting frothy, or perhaps the valuations are a little high given some of the embedded risks, or are people still saying that the relative valuation is there?
Relative value still looks good, but debt investors need to be wise about this. They need to find the right CLO manager, as corporate credit might take a whole repricing a year from now, and that could be very dangerous for certain investors in CLOs.
All right, and that certainly, I'm sure, is music to a lot of CLO managers' ears who are saying, we're the good guys. Stay away from all the bad guys out there. It does matter how good your manager is. Meanwhile, Kelsey, private credit is getting so hot. Some funds are looking for ways to get mom and pop investors into the game. Kelsey, what's the latest on that?
So we recently saw a bit of news come out of 9point, which is a fund based in Toronto. They're really seeing an opportunity in targeting retail investors. So mom and pop that want to take advantage of the yield that you're able to get into private credit, but are still scared of the illiquidity that there is in the asset class. So 9point has created a fund that invests in private credit, but also offers a bit more liquidity through this product.
So, yeah, this does raise a question because private credit is thought of as a highly illiquid form of asset, and yet typically mom and pop investors are looking for daily or weekly liquidity. So what are some of the measures that people are taking or ways that people are mitigating that risk?
Sure. So 9point, for example, it's putting about 20% of the fund into liquid securities or cash to give a little bit of that liquidity. But they're also putting in some measures to only allow investors to pull out with 30 days notice. And if redemptions hit a certain threshold, they're able to space them out over 18 months. So it does create a little bit more liquidity than you would typically see in a private credit fund, but it's still a long ways away from, the typical investment that a retail investor could would typically make.
Kelsey, just real quick here, do you get the sense that this is getting adopted more broadly, the idea of trying to cater to mom and pop investors for private credit?
Well, retail investors right now really make up a very small part of private credit funds, but as the industry grows, right now the asset class is $800 billion, we're going to see more and more folks try to expand their breadth of investors, and we could see more coming this way.
Kelsey, thank you so much, and to all of our reporters, we appreciate it. It brings us to my next guest, Jan.28, chairman of the private equity advisory firm Triago. He recently published his outrageous predictions for 2020. There were 10 of them. We chose 3 to highlight here. One of them really caught my eye, this idea that BlackRock would launch an artificial intelligence mega fund with record low fees. Please explain.
Well, I think this is going to happen, actually. I'm not sure this is going to happen this year, but this is going to happen within the next years. There is a lot of money that's trying to get into the asset class, and most of the large players, most of the mainstream asset managers want to get in the asset class, and they want a cheap way in. So I guess AI is probably the best way to get there.
Well, the whole concept that really drew me in here is what kind of fee pressure there would be on private equity, because we've seen private equity sort of as a haven, at least for asset managers, to still get paid while they invest. How long will it remain that way as you do start to see this competition?
Well, the 2 and 20 rule has been there forever, right? 40, 50 years, and this is still the case now. Funds basically charge a 2% management fee and like 20% carried interest. And this is still the case now. Is it going to go to 0.25 or low, or as low as that? I'm not too sure this is going to be quick. The question is, do you have the people to do that? It's going to be difficult to have the great talent if you pay them 0.25. But if it's a robot, a machine, then 0.25% is, I guess, enough.
Okay, but how do you have a robot actually analyzing a company and being on the ground and doing the kinds of intensive research and creative research that typically private equity firms say they do?
Yeah, I think this AI thing won't solve them up, won't change everything, right? It will create a new kind of private equity play where it's really artificial intelligence driving the search for companies and the search for good returns. But this won't take the traditional private equity crowd away from this market.
All right, let's go to one of your other outrageous predictions, that Barclays, Prudential, and Tesco would all go private.
Yeah. Private because right now there's something called Brexit going on, and
Never heard of it.
Many investors in the UK are trying to, take a break from the risk. And they may actually sell to people ready to take more risks. And I think that at the same time that these guys are looking for a way out, private equity funds are looking for big deals, interesting deals. They know how to weather uncertainties, and this, maybe the traditional stockholders don't.
I'm struggling to understand who would be the buyers. I mean,
the buyers would be large private equity funds, probably together with their own LPs.
So Blackstone could buy Barclays?
Maybe.
You think that that's feasible?
Yeah.
All right. The other outrageous prediction that you have is that Charles Schwab would buy KKR. And this sort of was, to me, very interesting because it highlighted a trend. Again, going back to private equity being kind of the engine of profits, or alternative assets being the engine of profits at a time of shrinking fees on the sort of more publicly traded assets. Do you think that a major broker could buy one of the major alternative asset managers?
Again, I think this is not a question of if, it's a question of when. This will happen. Most of these big firms, most of these giants want to get into private equity. They can either make it or buy it, or go the AI route. But buy it is probably the most, the most immediate way in. Well, so this is probably what they will do.
Charles Schwab is an interesting choice of yours because they also pioneered the lowest fees among the brokerages.
Indeed.
So why would that be the best candidate to take over KKR, and why would KKR be the best subject?
Well, I think I think Schwab could be an example, but most of the other big ones could be that buyer too. Again, they want to find the good way for their retail investors to get into this asset class, and buying an existing giant in PE is probably a good choice.
How often are your outrageous predictions true?
Last year, I think 3 or 4 were actually quite good. So I hope that this time it's going to be again 3 or 4. So they're not that outrageous, actually.
Wow. Thank you so much. Antoine Dreen, Triago Chairman, thank you so much for being with us. Coming up, Armin Rothhauser from Starwood Capital Group joining me to discuss the record amounts of dry powder on the books of infrastructure funds. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, our look at some of the most notable names in private markets. Cash has been flooding into global infrastructure funds over the past few years amid the race to private investments. And this has left firms with record amounts of dry powder to deploy in an increasingly expensive world. Navigating all is Armin Rothhauser, head of non-real estate debt investing at Starwood Capital Group, which has more than $60 billion of assets under management. Armin, can we just start with what has been driving this record volume of dry powder collecting on books? Is it because of the fundraising being successful, or because there just aren't opportunities to deploy the money?
Yeah, well, I think, Lisa, it's really a twofold, which is, we're really seeing people being interested in investing in real assets. I think that has a real appeal to folks. I think people can get their hands around the concept of infrastructure assets. We're seeing a road or a tunnel or a bridge or a pipeline. And I think also it's been harder and harder to deploy assets because there's been so much capital, really accumulated heavily in Europe and now starting to really form in the U.S.
All right, but people have understood roads for a long time. Why now?
Well, I think it's really a function of there's a need to really upgrade our infrastructure. We've seen, obviously, the challenges we have in the U.S. where our airports are really challenged around, looking and feeling like they have in Europe. But in Europe and in Asia, we've really seen, the social requirement around having upgraded infrastructure. And so, the public demand is there and people are accepting of that concept.
So where are you making money, actually, as an investor?
So for us, I think we're, if you think about Barry Sternlicht and the firm of Starwood, we're very focused on real assets. And Barry's thesis and the entire management team's thesis at Starwood is really around looking at assets that we can understand, we can develop, and we can own to the extent we make a loan that doesn't go our way. And so we're focused heavily on transportation. So transportation for us is a big focused on infrastructure.
Yeah, but what does that mean in terms of buying an airplane or lending
against aircraft is one of the things that we find is really interesting at the moment.
What kind of returns in that?
Well, you're going to get, mid-teens returns from our perspective. We use a little bit of leverage like you would in the CLO markets to deliver those returns. But there's really been a bifurcation. And one of the key factors around hard asset lending is European banks have always been the lender to that space. And Basel IV is going to make it more and more challenging for them to be able to lend into hard assets. And so we think, just like the private credit markets 7 or 8 years ago, 90% was in the bank markets. We think over the next 5 or 6 years, you're going to see that shift for all hard assets to move out of the European bank markets into private asset managers.
A lot of times when I talk with fund managers for infrastructure-focused funds, they talk about the energy sector and the shale boom.
Yeah.
And I'm thinking about right now as we see the price of shale, or the price of crude just generally fall and increasing numbers of bankruptcies. Are there opportunities or are there landmines out there for you?
Well, the answer is both. There actually is both. And energy, is a really bad word in the financial markets these days, and it really has, created some opportunities. We call it baby with the bathwater opportunities, where energy itself has been challenged to find even any lenders in the upstream space. But energy itself is a very wide swath of types of assets. So what we do is we look for assets where there's contracted cash flows, there's assets that have real tangible net worth. Replacement value to us is something that we can price effectively, but there is money to be made in the infrastructure space around energy.
When it comes to some of these opportunities, how is there still value given how much money is coming into this space?
Yeah, I think that the money itself is very focused on traditional infrastructure.
Which is what?
Roads, bridges, and tunnels in Europe. And there isn't a lot to invest in because there hasn't been a lot of development here in the U.S. around roads, bridges, and tunnels. And so where you're seeing alternatives is either water. There may be water systems you can lend money against. There can be pipelines, LNG terminals, et cetera. There's lots of opportunities there.
How do you source these?
Well, we were lucky enough to purchase GE's energy lending team about a year ago. And that has been, created a team. We have around 25 people on that team, have been doing energy lending, infrastructure lending for the last 25 years together. And so they help us source our opportunities.
Do you think that 2020 is going to be another record year for fundraising in this space?
I do.
Yeah?
Yes.
And where do you think most of it's going to go?
I think it will. I think the energy and infrastructure markets will be a big focus. I think private credit, which this is kind of moves into, will also be a big focus, as we saw in last part of your show. Is it's becoming more and more popular with even retail investors.
Armin, thank you so much for being here.
Thank you, Lisa.
Armin Rothhauser from Starwood Capital Group. Thank you. Coming up, Fairway Group goes bankrupt for the second time since 2016. Next, our guest says the New York grocer was mismanaged and looted by private equity. We get into that debate. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Fairway Group has gone bankrupt for the second time since 2016, overwhelmed by its lingering debt load and cutthroat price competition in the grocery business. Bloomberg opinion columnist Joe Nocera says it is a story of mismanagement and the grocer was looted by private equity. He joins us now. Joe, a fascinating story. Fairway, first, for people who do not live on the Upper West Side of Manhattan, has been known as a place with 50 different brands of olive oil and specialty cheeses. What happened when it was taken over by private equity?
Nothing good. Nothing good. It was taken over in 2007. It has never made a quarterly profit since then. It accumulated a lot of debt. Then it went public in 2012 without making. It expanded a little bit, accumulated more debt, went bankrupt, accumulated more debt, is bankrupt again.
People would argue private equity is unfairly pinned for bankruptcies because they end up taking over troubled companies and try to help them, and sometimes they can't be helped. Why is this case just not a case of a failing company having failed?
Well, there's several reasons. The most important reason is that this was a chain, a New York chain that consisted of 5 supermarkets. 5. Sterling Investment Partners, the private equity firm, wanted to turn it into a 300-store chain without any supermarket management experience, with nobody on the board with supermarket experience, and it was a ludicrous plan. It's so New York, Fairway. It doesn't translate outside of New York.
Well, how much is this an idiosyncratic case of managers, private equity management, misreading the potential for a company, and how much is this an endemic aspect to private equity investments?
The part that's endemic, it's part of both. Most private equity firms don't come into companies and say, let's take your little tiny company and turn it into a national chain. That doesn't usually happen. But I do believe that the amount of debt that they glomp onto these companies, the amount of money they take out in fees for doing not a whole lot, the amount of dividends that they take out, has been very destructive, especially in the retail arena. We've seen liquidations, Toys R Us. We've seen companies, lots of companies go bankrupt, and they're struggling. And part of the struggle is, in a downturn, they have so much debt they can't handle it.
What kind of pushback do you get to these columns? Because this is the second one that you've written in a while.
It's very funny. On the terminal, I get a ton of pushback. On Twitter, they love me.
That pretty much sums it up, right? It's sort of know your audience. Joe Nocera of Bloomberg Opinion, thank you so much for being with us.
Thanks for having me.
Time now for this week's Billionaire Beat. And wealthy investors are almost unanimously optimistic about markets this year. That, according to a new survey on UBS Global Wealth Management. Bloomberg's Tom Metcalf joining me now for more. Tom, please explain just how optimistic are these wealthy individuals?
Yeah, it's pretty remarkable. So there's this UBS survey of about 5,000 very wealthy people, and 94% of them basically reckon 2020 is going to be an up year for their portfolio. So in the world of markets, that's pretty much as unanimous as it gets.
All right. So are we seeing this pretty much no matter where people are, or are the differences depending on geography?
So largely, it's pretty positive around the world. I mean, the US stands out as being the most positive. But you go to Asia, people are expecting growth. Probably the one area or region where there's sort of a bit more pessimism would be in Latin America. and that's kind of driven by sort of the difficulties in Argentina at the moment. But if you look at Europe and America, despite a few sort of macro worries, they all seem to think, they've worked out how to make money this year.
All right, so how are they going to make money this year?
Well, it comes down to one thing, equity, basically.
Right.
At Davos recently, you had Ray Dalio saying, hey, cash is trash. And basically, that's what all the investors are saying is, you might have to stomach some volatility. You've already seen that this year with sort of the upswing from, say, the US-China trade deal. Sort of maybe, and then recently the worries around the virus cutting that. But if you can stick with that volatility, people think, you're going to make a lot of money out of the equities this year. Go overweight.
Does anyone have any worries, or is it just basically smooth sailing from here on out?
Well, 6% are sort of saying, hey, it's not going to be an up year. I think probably the thing to sort of caution this is, this is sentiment, right? This can change in a flash. So the last time UBS did this survey, something like 50% were thinking, we're a bit more pessimistic about 2020. So, I think if there's sort of a run of bad news, and like everything, the herd will change, and we'll be talking about something very different next time.
And going forward, what about emerging markets? I know that just among mainstream investors, that's been an area that people have been a little more optimistic about. Is it the same?
Yeah, again, that's sort of the advice coming out of this survey is look to emerging markets. That's, the idea is there'll be a lot of growth there, and assets there are much cheaper, particularly in comparison to, say, the US stock market.
All right, Bloomberg's Tom Metcalf, thank you so much for being with us. Speaking of big money, it's time for this week's big number, and it is $764 billion. That's the amount of money Americans are projected to inherit this year, paying an average tax of just 2.1% on that income. This, according to a new paper published by the Brookings Institute. That does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, and 2 a.m. in Hong Kong. From New York, this is Bloomberg.